Darwane, now let's move to the next adjustment, that's bad debts. So according to A levels, we call this as impairment loss on trade receivables. Nayagati Hani Karna Labh. So bad debts means, dear children, irrecoverable amount from debtors. According to O levels, irrecoverable amount of debtors, not recoverable amounts, irrecoverable amounts. So, dear children, because of as a result of selling goods on credit, what can you see? You can see receivable amount of cash. Because of selling goods on credit, we sold goods on credit. Now you can see receivable amount of cash. Now I'm talking about from out of the total receivable, if the business cannot recover certain amount my dear children, out of the total debtor receivables, if the business cannot recover certain amount, need to recognize it as bad debts. So no point in recognize irrecoverable amount still as debtor receivables. ලැබෙන්නේ නැති සල්ලි තවදුරටත් මොකටද ලැබෙනවා කියලා හිත හදාගෙන බලන් ඉන්නේ. So, due to death of owners, due to being bankrupt, my dear children, there are some instances where we can't recover these receivables. So, in that instant, need to write off, dear children, such amounts as bad debts. Need to recognize such amount as irrecoverable amounts. In simple terms, as bad debts. So, let's directly move to the impact for the financial statements because of bad debts. So, now in the trial balance, you can see debtor receivables as 21,000. Okay, dear children. Now, under additional information, you can see the management has recognized 1,000 as bad debts. 1,000 as bad debts. So, what is this 1,000? Out of the debtor receivables mentioned in the trial balance, 1,000 can't recover. So, directly, let's see the impact, my dear children. You already know bad debts. Because of bad debts, what happened for our debtor asset? It's going to decrease. It's going to decrease. Debtors means receivables. Because of bad debts, what happened for our receivables? We are going to lose 1,000, no? So from the point of view of the business, we need to recognize bad debts as an expense. So here we can recognize, my dear children, an expense. So when increasing expenses, debit. Bad debt account, debit. So expenses we present in the P&L. What's bad debts? Bad debts, you can see now you have to recover. Now you have to write off 1,000 as bad debts because of selling goods on credit. So that is because of distributional activity. So bad debts you need to recognize as a distribution expense, dear boys and girls, right? So 1,000 you need to recognize as expense, right? Okay. Adjustments we need to record in two places, as same as recording here 1,000. Because of bad debts, what happened for the debtor asset? The debtor asset, dear children, debtor asset decreases when decreasing assets credit. Now, because of bad debts, this debtor decreased by 1,000. And now, finally tell me the debtor value. It should be 20,000. So out of 21,000, recognize 1,000 as bad debts, and therefore debtors should decrease because this 1,000 can't recover from the debtors. And how much is accurate debtors? You know, debtors as current assets. We expect to convert debtors into cash within next 12 months. So debtors are current assets. So how much is the recoverable amount? Only the receivable amount. Now it is 20,000 after recognizing 1,000 as bad debts. You know what's the double entry for the bad debts, guys? Bad debt account debit, debtor account credit. Bad debt account debit, debtor account credit. So what are the steps that you need to follow when doing this adjustment? So identify the amount given in the trial balance as debtors. Then read the additional information, write off 1,000 as bad debts. Seriously, you have to write off 1,000. So this 1,000 you have recognized as bad debts, which is a distribution expense. And because of recognizing as irrecoverable amount, debtors should decrease. So when presenting debtors in the SOFP, deduct that 1,000 from the given amount in the trial balance, and you can present the real debtors now. So from 21,000, after deducting 1,000, you need to present 20,000 as debtors. 1,000 is a bad debt, so it is an expense as well as affect to decrease the asset. I think this is clear for all of you. I will present you another type of question, my dear children, with related to bad debts. Okay, now I'm going to teach you another question, my dear children, from the same adjustment, bad debts. What is the difference here? You can see a bad debt amount already in the trial balance and the debtor balance also 21,000, and as same as an amount which mentioned in the trial balance as bad debts, you can see under additional information also 1000 should write off as bad debts. So dear children, if you can see 4000 as, if you can see whatever amount as bad debts in the trial balance, that means this amount already recognized as bad debts after deducting from debtors. This 4000 has already deducted from debtors and recognized as bad debts, not at the end of the period, during the period. That's why you can see in the trial balance. This 4000 has already deducted from the debtors and recognized as bad debts. Debtors again galola aragena bad debts idira dala තියෙන්නේ. ඒ කියන්නේ already deducted from debtors. And it is a bad debt. You know bad debts as an expense. Hari. Another 1000, my dear children, need to recognize as bad debts. Under additional information, this 1000 has not deducted and not recognized as bad debts either. Then, dear children, you know bad debts we need to record as a distribution expense. I told you earlier. And debtors we need to present in the SOFP as current assets. Tell me the debtor value. Debtor value is 21,000. Now, dear children, you can see already 4000 as an expense in the bad debts. Now, let's go for the adjustment. You can see already 4000 as bad debts. You can see debtors as 21,000. See? Now, let's go for the additional information. Write off another 1000 as bad debts. Hey, now, you need to write off another 1000 as bad debts means you need to increase bad debts by another 1000. You have to increase bad debts by another 1000. No? Because of recognizing another 1000 as bad debts, whatever the debtor value? Debtor value should decrease by another 1000. Now you can clearly see the total bad debts as 5000, the debtor value as 20,000, dear children. So this is how we need to answer, my dear children, if you can see bad debts already in the trial balance, right? Right, okay guys, we can move to the last adjustment, that's depreciation, right? You know, we depreciate non-current assets. So what are non-current assets normally? Excluding land, we can depreciate the rest. Buildings, motor vehicles, furniture. Why do we need to depreciate these? Because of using, we can see decrease in values over the useful life of these assets. So each of non-current asset has, my dear children, a certain useful life. It can be 5 years, 10 years, 20 years. Within that 20 years, what will happen for the value? The value getting decreased. So according to the prudent concept, there's an accounting concept called prudent concept. We are teaching it for advanced level students, but you already know, I taught you also, prudence means for the anticipated losses, we need to recognize as soon as possible. Anticipated losses, we need to recognize as soon as possible, my dear children. You know definitely the values of buildings, the value of motor vehicles getting decreased because of physically wearing, damaging due to being outdated. Each year we need to recognize certain amount as a loss, my dear children, as an expense. That is called depreciation, right? Here let's discuss how to make adjustments, my dear children, in the statement of profit or loss and statement of financial position. So if you notice depreciation adjustment, you need to change the SOFP, dear children, and you need to prepare 3 columns to record amounts: cost, accumulated depreciation, and the net value. And if you notice depreciation, prepare the SOFP like this, dear children: cost, accumulated depreciation, net value. Okay, I will teach you depreciation from the beginning. You can see buildings at cost. What do you mean by cost? Cost means the purchase price. Not only the purchase price, it includes several things, you know. Purchase price plus expenses that incur when bringing the non-current asset into current position and turning the non-current asset into usable condition. So anyway, forget about that. Here we bought buildings, my dear children, at a cost of 100,000. And already you can see accumulated depreciation. What do you mean accumulated? Sammuchita share. That means this is the depreciated amount, my dear children, so far. This is the depreciation amount already. This is already depreciated amount, my dear children, by the business, 40,000. Okay, out of the cost already depreciated 40,000. What is this accumulated depreciation account? This is an asset account, my dear children, which you use to decrease the non-current asset. Asset when decreasing assets credit out of the cost of the building already depreciated 40,000 as at 1st of January. Up to the beginning date of the accounting period, depreciated 40,000. Now under additional information, you can see the adjustment. What dear children has not adjusted yet. During the period, another 10,000 you need to depreciate. another 10,000, another 10% you need to depreciate from it cost again. Enam menne meka mehemai karanne buildings, my dear children, you need to recognize as a non-current asset. In the SOFP, you need to record the cost first. Cost take a mulimalian. Cost take a mulimalian. Then, my dear children, already you can see accumulated depreciation as 40,000. Don't record here, but already you can see accumulated depreciation 40,000. Now let's have a look. According to additional information, we need to depreciate another 10% from the cost of the building. So cost is 100,000. We need to depreciate 10% during this period, and that is 10,000. And this year depreciation is 10,000. What's a double entry? Depreciation we need to recognize as an expense, and depreciation on building account debit 10,000. You know, expenses we need to record under P&L. What's this? Dip on buildings. No, apart from dip on delivery vehicles, the rest we can consider as administration. Enam puthe administration expense ekak vidhiyata treat karana, consider as an administration expense. Dip on building, depreciation on building. How much? 10,000. 100,000 into 10%, 10,000. Puthe the same 10,000, because of depreciating 10,000 from buildings during the period, the asset should decrease. I told you we present the decrease in assets because of depreciation by using another asset account that is called accumulate. And you need to add another 10,000 to the accumulate. And asset should decrease by another 10,000. And accumulated depreciation account credit. Here, because of depreciating, even though we depreciate, we don't directly decrease a cost. Cost doesn't change, no. Gatta gana venas wenne share karai kiyala. However, because of depreciating, asset value should decrease, and by using another asset account called accumulated depreciation, we present this decrease. Got it? How much is accumulated depreciation? The total depreciated amount. Earlier there was 40,000, and during the period we recognize 10,000 as an expense, and our total accumulate should be 50,000. Total accumulate should be 50,000. Then after considering all the total accumulated depreciation so far, tell me the real value that we need to communicate to stakeholders as a value of non-current assets. Tell me the net value. We call it as carrying value as well. How much is the net value of the carrying value? 50,000 is a real value at the end of the accounting period with regard to buildings, I mean, right? And what you have to do is, if you notice depreciation adjustment, come on, from the cost, calculate the whatever percentage it is an expense and add it to the accumulate, then present here the total accumulate, and you can now find out the carrying value, dear children, right? I will give you another one, try that one, and that means we have discussed 4 adjustments, my dear children, through this video. So let's try this. You can see delivery vehicles at cost as 200,000 in the trial balance. So first of all, you need to recognize it as an asset. Cost is 200,000. Record the cost. Now already out of the cost of the delivery vehicle, already depreciated 80,000, my dear children. You can see it as accumulated depreciation. Now what is this account? Asset account, which you use to decrease the asset, right? Then look at the additional information. We need to depreciate delivery vehicles by 20% at its cost, dear children. During this year also we need to depreciate. So this 80,000 has depreciated during previous accounting periods. So during this year also we need to depreciate 20,000 from the cost of the delivery vehicle. So calculate 20%. That is 40,000. 200,000 into 20% from the cost. 20% is 40,000. 40,000. No. So this 40,000 we need to recognize as an expense. What's that expense? Delivery vehicles normally we use for the distribution activity. So distribution expense. Dear children, under distribution expenses, we need to record dip on vehicles, dip on delivery vehicles as how much? 40,000. 40,000. We need to recognize this as an expense. Depreciation account debit. Dip on delivery vehicle account debit. Expense account debit. And because of depreciating the vehicles by another 40,000, the value of the vehicle should decrease by another 40,000. And when decreasing assets credit, Previous depreciated 80,000. During this period also depreciated another 40,000. How much is the total accumulated depreciation? Here you need to present the total accumulated depreciation 120,000. 80,000 plus this 40,000, 120,000. How much is a real value, carrying value of the delivery vehicle at the end? Only 80,000. So this is how you need to do this adjustment, dear children. What's the double entry for the depreciation anyway? Depreciation expense account debit, accumulate depreciation account credit. What is this accumulate account? Asset account. Because of depreciating, asset decrease. Yeah, this is an asset account which we use to present the decrease in the non-current assets because of depreciating, right? Okay. So dear children, we completed all 4 adjustments. So first of all, when you prepare finance statements, prepare both structures, right? You can write down after the gross profit, then leave enough space under the other income, distribution expense, administration expense, financial expense. Prepare the SOFP as well. Prepare in this way. If you can say depreciation, cost, accumulated depreciation, carrying value or the net value, NCA, non-current assets, then current assets, then equity plus liabilities. So leave space and directly start from additional information. Like I told you earlier, accrued expenses, income receivables, bad debts, depreciation. After adjusting all, you can record the rest, and you can, my dear children, finally present the financial position. Assets should equal with equity and the liabilities. So dear children, I think this will help you for your term test as well. So however, we discussed a lot of classroom tests, dear children, so far. I think we completed 12 or more than classroom tests, and we did MCQ series up to now. So prefer all these questions, and dear children, all the best. Thank you for joining.